Hello, my name is Eddie Tofbig. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. Since late March, possibly mid-February, two patterns tried to catch the mood of the market. The first was the previously mentioned mid-February to early May pink descending triangle pattern type, which we are finished with back in early May. It is not a perfect pattern by any means. However, the pink upper trend line, though previously breached, did show merit, and the flattish pink lower trend line, currently at 539, did hold up the market for a while, though it gave way in late April. Yet with changeover, I have been forced to rethink this once more. More on this shortly. The second pattern still utilises the pink lower trend line, but instead is a smaller pattern and dates from mid-March, this week with a bright red upper trend line. This had a break on the downside at the end of April, but with changeover, prices have found themselves initially back within the descending triangle, and then last week back out again, but this time breaking higher out of it. Both are usually seen as bearish patterns. The last one especially, and I earlier gave some potential targets below for the first larger pink descending triangle of a primary target X in the 490 zone and a secondary hard to reach target X1 down in the 471 zone. I said 4 weeks ago that, and I quote, "I'm not too sure about these two, but for now they will do," end of quote. I approached them in the same way over the last 2 weeks, and the reason why was because I suspected there was and is some pretty good support below, specifically the not too far below 38.2 absolute Fibonacci line at 521. This held up the market effectively back in August last year, and though pierced 2 weeks ago, prices did not stabilize below it, even before changeover. With the subsequent moves higher, I started considering retiring both the primary target X and the secondary target X1. However, this week's decline has put that idea on hold, and I will leave all the targets below where they are for now. I would still nevertheless watch on the top side the December 2020 low at 566 plus the flatlining mauve medium moving average, currently 559, and especially the flatlining gold long moving average, currently 567. As this is where the market became bogged down last week. Just bear in mind that beyond these we have some clear air above until the congestion at 588 and the March 2021 low at 592. Overall, this is the second break from these triangles, and I still cannot get the idea out of my head that having advanced so far along these patterns that we might be handed here a double bluff with now a second possible false break, this time higher. It was as I added at the end of my commentary last week, and I quote, "I would be very cautious about this break high because of that, and wait maybe another week, maybe 2 weeks, to see the strength of this move higher, as so far it seems the mauve medium moving average and the gold long moving average are capping prices," end of quote. Chicago corn. A major move was seen here at the end of February and going into March. The end of the upwards move we'd seen since the start of the year, and a quite sharp move lower. At the time I said, and I quote, "All this raises a question as to whether we have potential here for a further bearish halfway hesitation or a double bottom," end of quote. The market followed the path for a double bottom. In the move higher, the market reached the primary target at 497. But did not manage to reach the secondary target at 504 before heading lower once more. As a result, 2 weeks ago I drew a mid-February to mid-April bearish Andrews pitchfork, which, whilst not being exact as the upper tine, currently at 440, it has been breached on a number of occasions. The upper tine still nevertheless showed and still shows the bearish angle of attack of this market. I choose the steeper bearish Andrews pitchfork over the shallower bearish shift pitch because I think it is a more suitable representation on the way the market is moving lower. However, and it's important however, I quote from last week, however, that being said, whilst it's not represented here, the tine's next crossover this coming Monday the 19th of May, so watch out for one or more of the following then: a change in trend, a reinforcement of an existing trend, volatility. Coincidentally, after changeover this week, prices are now testing the 50% absolute Fibonacci line at 425, so it's worth being cautious right now. End of quote. The caution was well rewarded, as on Monday the 19th we had a combined key reversal up, if only just, plus a bullish engulfing pattern and a bullish opening white Mariposa, and prices rose in the early part of last week, filling in the changeover gap and thus fully justifying the time crossover warning I'd given. This left me wondering last week, and I quote, what may lie ahead? Right now it looks like the upper tine is still in control, especially if prices manage to move back down below the November 2020 high at 439. However, please keep a wary eye above on the gold long moving average, currently at 452, and I would also watch the unhighlighted lower trendline extension, currently 460, of the July 23 to January 24 descending triangle pattern, as this seems to be the centre of some congestion, as we saw back in late December last year through to early January this year, as well as between March to April this year. End of quote. All these points were well valid, but if I go to my first point, which is the upper tine is still in control, and this week has seen prices move down towards mid-May's low at 421. The next support of note is the December 2020 low at 415, which ties in with the low of late November last year. Then supports fairly evenly spaced out at 409 and 403 until the November 2020 low at 397. And that is just about as far as I like to go now before I once more review the market action, should we get down that far. Kansas City wheat. Since mid-February, two major patterns have developed here, one of which is still live and a third that's no longer operational, but from which we have some echoes that resonate even today. The first pattern is a mid-February to late April sideways triangle, made up from the bright pink uptrend and the bright red downtrend. It is not a great looking pattern by any means, but it nevertheless still exists. And 6 weeks ago prices pushed down below the pink lower trend line, whilst at the same time following on lower from a mid-March to early May bearish halfway hesitation pattern. Now the second pattern is a February to March based bearish shift pitchfork, with prices still live within this pattern. 2 weeks ago we saw the market test the unhighlighted lower tine, currently at 498, piercing it but reverting back upwards almost immediately from the previously highlighted unreconstructed December 1999, that's how old it is, 1999 today uptrend that was nearby, currently at 504, and that was before changeover. Last week prices pierced and for a few days started resting on the middle tine, currently at 545, as well as the March 2024 low at 551, then pushed up as far as the March 21 low at 559, and especially got capped by the green short medium moving average, currently at 559. But this week the market reverted back below the middle tine, though not by too far. Finally, 4 weeks ago prices broke down through the also unhighlighted lower tine, currently at 549, of the significant, very shallow, late August to early December 2024 broken bullish shift pitchfork. Yeah, but last week we had seen prices move back above it once more and also start to rest upon it. This has not really lasted, as this week we were back down below it and outside the shallow bullish broken shift pitchfork once again, though today we have seen an attempt to go back above it. Okay, so going back to the first pattern again, the sideways triangle, I said 4 weeks ago, and I quote, all this action has nevertheless still left us with some targets below for the sideways triangle pattern type. We have a primary target X in the 522 zone, not too far away, and a secondary harder to reach target X1 down in the 471 zone. I'm not too sure about these two, but for now they will do. End of quote. Well, the primary target X did very nicely, being achieved soon after my video back then, but the harder to achieve secondary target X1 is still open and now has a figurative question mark placed next to it. You see, it was as I said 2 weeks ago, and I quote, I am still not too sure about this lower secondary target, but as I said before, for now it will do. End of quote. So I will leave this secondary target X1 still on my daily chart for at least another week or two, just in case, as we have not as yet created the conditions for a significant bullish pattern to emerge, not just yet, though I still have my doubts about target X1 below. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.